all taxes
Right.
effectively will prevent growth. So that said, what do you think of the choices that the Chancellor has made in terms of the taxes that he has chosen to cut and those he has left alone?
Well, the two big measures in the budget which do reduce tax are the corporation tax measure and the national insurance one. The national insurance one is helpful on the supply side, and we try and calibrate how helpful it is in bringing some people into work who wouldn't have worked, because you reduce the tax from working with the 2 percentage point cut in the national insurance. And it also has an impact a bit on the incentive of the people who are already working, maybe to work a little bit more. So that does something. It brings, in terms of how many more hours are worked in the economy, something close to 100,000 full-time equivalent extra workers from that measure. Of course, it's not free, it's not cheap, because it costs £10 billion a year, but you get some of that back because more people are working. The other one, it was the measure on full expensing of investment. That's also quite expensive. At least it is expensive immediately. It becomes actually cheaper in the long run in terms of the hit to corporation tax. What it does do is effectively lowers the tax rate on investing in certain kinds of assets, plant and machinery in the UK. That also does something positive on the supply side. We calibrate that. It's not quite as powerful as the national insurance measure, but it adds a bit to the potential productive capacity of the UK economy. And both of these things, as long as they're in place, are permanent positive effects on the supply side, which offset some of the tax costs.
Effectively, what we've done is seen measures which will drive growth. So, given the taxes that have been chosen, it does actually work.
They have helpful supply side effects, yeah.
Okay, and what are the things that effectively didn't change, which will negatively affect growth?
Well, what didn't change was the freezing of the tax thresholds. And that has some disincentive effects, because if people are pushed up into higher tax bands, either they weren't paying tax and they become basic rate taxpayers, or they were basic rate taxpayers and become higher rate taxpayers, the amount of money they get to keep out of the extra hours they might work in a week clearly goes down, and it goes down quite a lot. If you go from 20% to 40%, it's a meaningful change. So that has in itself a negative effect. There's actually another effect which perversely is potentially positive on supply, and that's, imagine now the person that doesn't go from being a basic rate taxpayer to a higher rate taxpayer because you freeze the threshold, but as time passes and inflation means that wages tend to move up, they nonetheless pay a higher proportion of their salary is paying tax. So it doesn't change the marginal tax rate, that stays at 20% on basic rate income tax, but they just, more of their salary is paying the basic rate. So they'll find that erodes the real value of their earnings. It doesn't change the incentive to work at the margin, but it changes the absolute amount of take-home pay. For that individual, if anything, because their standard of living has declined as a result of this, they might actually work a bit more. So it has a kind of slightly perverse positive incentive to work, but it's unambiguously, there's a negative effect for anybody who crosses the boundary and now pays a higher rate of tax at the margin.
Got it. And while you're not a behavioural psychologist, overall, given the choices that were made, are we going to see overall more people incentivised to work rather than less?
The national insurance one, I think, is unambiguously a positive. More incentive to work, so that's a definite positive. The threshold freezing is actually quite complicated to work out because most people don't cross the boundary. They stay basic rate taxpayers, they stay higher rate taxpayers, or they stay non-taxpayers because they don't get to the limit to pay tax. Most people don't change the boundaries, but a lot of those people might find that their standard of living is a little bit lower, and so they have an incentive to work more. There's a smaller group of people who face a really substantial change in the incentive to work at the margin, and they work less. At the moment, we're doing some analysis trying to work out what the net effect of those is, and it's actually pretty complicated. We'll have a clearer view on it by the the spring budget, and we'll be able to give you a firmer answer on what the net effect of that is. But the national insurance thing in itself is a positive for the supply of labour in the UK.
That's very helpful, and I look forward to your further work on this topic. I think for me, one of the unanswered questions is I hear what you say, that people will be disincentivised if they find themselves moving it to the next rate. But some people don't have a choice of working less. There is the job has to be done, if you see what I mean. But I'm not quite sure how you might factor that in. But clearly that's for the spring budget. Chairman.
Thank you. And I think that the Chancellor and the Office for Budget Responsibility, you've been doing a lot of work on these behavioural aspects of your forecasting, and we note the op-ed that you wrote, Professor Miles, in terms of this behavioural work, which is of great interest to the committee, and it's interesting to hear some of the challenges, but some of the decisions that you've made on that. Keir.
Hello, thank you. In the Economic and Fiscal Outlook, you wrote that the overall 3.5% peak to trough drop in real household disposable incomes per person between 2019 to 29 to 2024 to 25 is still the largest reduction in real living standards since ONS records began in the 1950s. So I was wondering kind of what, in your view, are the root causes of this prolonged fall in living standards, and are other kind of comparable countries seeing similar falls, and if not, why is that not the case?
I'll start out. My colleagues might want to supplement, but the sorry, the root cause of the fall in living standards is that inflation is outpacing growth in earnings, and it continues to fall in the early part of our forecast because while inflation moderates, it proves to be more persistent and therefore outstrips earnings for longer. There is also the fact that households don't just have the earnings that they've got what they earn, but they also have what they're either receiving or paying out in interest payments. And that can be a positive or negative depending on whether you're a saver or whether you have a mortgage or other debts. And also how quickly interest rates respond to rates on savings versus rates on mortgages. And one of the things which also drives a further squeeze on living standards in our forecast is the fact that interest rates on savings went up relatively quickly, although I know this committee was not happy with how quickly they did. But nonetheless, they responded more quickly than what happens nowadays with mortgages, because more people are on fixed rate mortgages. It takes time for them to roll off onto the variable portion and for that to reflect the latest market interest rate. So another thing which squeezes living standards in our forecast going forward is the fact that more people are rolling off that fixed rate portion of their mortgage and rolling onto a much higher variable rate. So in addition to having inflation outstrip their earnings for a further period, they've also got a higher mortgage payments on the variable rate. And it takes until the end of our forecast, which is 2027-28, before real living standards have recovered to the level at which they were before the pandemic.
And is it that combination of inflation and increased mortgage rates that produces, you know, this kind of unique, is it a unique kind of picture of living standards in the UK as opposed to other comparable economies? It's
not unique in Europe because most European countries, or many European countries, are net importers of energy and net importers of food. And because one of the biggest sources of the increase in prices, which hasn't been reflected in people's increase in wages, has been the fact that we are net energy importers, net food importers. When the price of things goes up, we just pay more. And because we're not producing that energy and we're not producing that food, it doesn't get reflected in higher take-home pay for us as producers. So for other European countries which are net importers of energy, they will also face big squeezes on living standards because we are particularly dependent on gas as our source of energy in the UK, and we import a lot of it. We are particularly exposed to a big rise in gas prices, which is what we've seen over the last 18 months.
Sure. And on that point around kind of household incomes, analysis from the Resolution Foundation shows that the autumn statement's provisions are likely to provide a greater income boost for middle and kind of upper income households rather than lower ones. And I was wondering if you could kind of outline what you feel the impact on different income groups' living standards will be as a result of these kind of discrepancies in distribution from those provisions.
Sure. The most sophisticated distribution analysis is done by the Treasury and by colleagues in the Resolution Foundation. We do it to the extent that we need to understand what it means for the tax and benefit system. Clearly, the measures taken in this autumn statement benefit, because they're national insurance reductions, benefit people who are working. And so it benefits people who are in the labour force and earning, rather than those who are outside the labour force and on benefits. It is also the case that benefits have been indexed to inflation. So they have been going up in some cases, at least in the last year or so, faster than wages. So people who are on benefits have seen the real value of those benefits keep pace with inflation better than nominal earnings. So in some ways, the real living standards at the bottom end of the income distribution have been better protected by those who are further up the income distribution, but not quite in the median or further up. And the full effect of tax cuts is clearly felt mostly by those who are working further up the income scale, because their average taxation rate is lower.
Sure. And, since ONS records began in the 1950s, we've seen other periods of kind of high inflation, whether that's in the 70s or the early 1980s, but we didn't see comparable falls in living standards to kind of what we see today. Is there a particular reason why the high inflationary period we're in now has produced this concurrent fall in living standards as opposed to other events in the past?
We've clearly seen imported inflation shocks in the past, and the energy crises of the 70s and early 80s were an example. I guess the things which distinguish this period from then is that back in the 1970s, productivity growth was relatively high compared to what we've seen now. So real earnings were growing relatively strongly. You had more of an embedded indexation culture across the economy, so more wage agreements, had inflation effectively built in, but that was one of the reasons why it was more difficult to get inflation under control, because price rises just got reflected directly into higher wages. But what it also meant is that, at least from year to year, what was happening with wages was reflecting recent outturn for inflation. A third thing that was happening in the 70s, which has largely run its course now, is that more women were joining the workforce. So you had more people earning in the economy, and that meant that household take-home pay was rising from the fact that you had two earners rather than just a single earner. So each of those things, I think, probably supported real incomes better through what was an equally dramatic imported inflation shock from higher energy prices in the 70s compared to today.
And Drew raised the point about kind of these implausible austerity measures that the Resolution Foundation has predicted will need to be implemented. And we've talked about those cuts to departmental spending. Are you able to offer a view at this stage about the kind of sacrifices that would require and their kind of concurrent impact on living standards in the middle to longer term?
I think we can say something about what it means for different government departments based on what the government's plans are for public spending. I don't know, Tom, whether you want to say anything about that.
So we've done some analysis in the book which looks at the implications of the current spending assumption that the government has, and taking into account the fact that the government has made a number of kind of commitments or has set out ambitions in certain areas of spending already, so in health, overseas development, education, and some other areas, and essentially calculated what that would mean in terms of the spending room available for all of the other departments, which is quite a significant chunk of spending, around 30%, and includes things like prisons, Home Office, and essentially that implies reductions in around between 2 to 4% a year in real terms in those other departments. So, fairly significant reductions. And going back to the discussion previously, the sort of question in terms of how that would actually impact on public service delivery would depend on the ability of the government to drive public sector productivity improvements. It would also obviously depend on the decisions the government made on the actual level of spending when it comes to set detailed spending plans in the spending review. So it's sort of difficult for us to say right now exactly what that would imply, because we don't have those spending plans. But we can, as say, look at the sort of overall implication of the current assumption, and it is one that implies quite significant reductions in the room for spending in those other departments.
Thank you.
Thanks, Keir. Is the overall package of measures that were announced by the Chancellor last week inflationary? Richard?
So, its overall impact on the price level in 5 years' time is to add 0.1 to the price level, which I wouldn't really describe as being material for our forecast. And that is partly because he is, on the one hand, raising lots of tax from frozen thresholds and then giving some of it back in the form of a rate cut. And so in that sense, the amount of money, and so over the 5 years, the tax system is taking money out of people's pockets rather than having it put back by the sum of government tax measures. It's also the case that because a number of the measures that have been announced in this autumn statement do support the supply side of the economy, they're not just adding pressure to demand, but they're also providing some supply to help support it, in the sense that there are more people working, there are people working longer hours, there is additional investment in our forecast, and that helps to compensate for what would otherwise just be a sort of pure demand pressure from a fiscal loosening. So I think what I would say is that I don't think that the impact of the policy package in this autumn statement makes a material difference to the outlook for inflation or prices. It does make a small one, however.
So the reason you've raised your inflation forecast is for other factors, is that correct?
It's for macroeconomic reasons, the fact that we think that the labour market is proving tighter, the fact that what survey evidence suggests about pay negotiations and pay deals indicates that higher pay settlements are likely to persist into the medium term.
And what impact has this massively upwardly revised net migration figure of 745,000 had on your ability to model the future?
Well, I mean, we already knew what the GDP number was for last year, and indeed for the first half of this year. So the fact that there were many more net migrants coming into the country than was thought before they updated the numbers for last year doesn't give you any more boost to GDP or tax revenues, because we already knew what they were. What it does do is probably make one actually a little bit more pessimistic, perhaps, on productivity, because GDP was what it was, tax revenues were what they were, but there were likely more people working. So average productivity, if anything, is a little bit lower than we thought before. The number of people coming into the country, and probably the labour force was higher than we thought before last week. I don't think it changes, looking sort of forward from where we start from. The assumption we've made on net migration is that it drops back to about 245,000. And that was, part of the reason for that was not changing that assumption actually from where we were back in March, was that seemed to be consistent with an aim, which I think is a government aim, to bring net migration back down to where it was a few years ago before COVID, which I think was running at about 250,000. Now, one might question whether that remains a sensible assumption. I think it probably does, because I think it's pretty clear just in the last week that the government is going to do further measures from those already taken to bring the level of net migration down. So I don't think the much higher number for last year and for the first half of this year somehow undermines the assumption that we make that it comes back down to about 245,000 by the end of the forecast horizon.
All right, thank you. Anne-Marie.
Thank you, Chair. Professor Miles, can we drill down a little bit further into national insurance?
Yep.
You have a pair of scales in front of you. On the one hand, you put the NI tax foregone.
Yep.
On the other side, you put the tax raised by not changing the thresholds,
Yep.
which is heavier.
I think over the next 5 years, till we get to the end of our forecast horizon 28-29, if there is no change in the policy on thresholds, and if there's no further changes in other aspects of tax on labour income or national insurance, then the extra money the government gets from the threshold freeze is bigger than the I don't like the word tax giveaway because it suggests that the government owns everything and it gives it back to people. But I'll call it a giveaway because it's just a shorthand. That's 10 billion, but over the next 5 years, maybe the government gets of the order of 30 billion more because of the threshold freeze. Not all the 30 billion more is coming from labour income, because people pay tax on interest income, investment income and other things as well. So it's not all the tax on labour income. But still, it's very likely, overwhelmingly likely, I think, that as things stand right now, if there's no change, the amount of tax in total people pay on labour income as a result of the threshold freeze is bigger than, more than offsets the cut from national insurance.
Thank you. Interesting. Can we then look then at each of the individual classes, Class 1, Class 2 and Class 4, all of which have received a change? Now, Class 1, I think that's the one you've been principally referring to in your answers to date, and clearly that will make a very significant impact on employment. Are you able to expand a little to explain in what way? And are you able then to expand a little further, not just to look at the impact of the changes in Class 1 on employment, but also on the wider economy?
Yeah, I mean, the employment effects, and it's primarily about Class 1, it's 12% going down to 10. It has two effects. Firstly, there's some people who at the margin thought it perhaps wasn't worth working, and now might be persuaded that actually they're going to actively try and get a job because they're going to get a bit more after-tax income. I mean, that's not a huge effect because it really affects people who are right on the borderline between shall I work, shall I not work. We think that's nonetheless worth about 28,000 more people in the labour force, and they'll stay there. The bigger effect is on the much larger group of people who are already working. There's a bit more of an incentive to work the extra hours because you get to keep more of it now. That's a much bigger effect. We think that's probably the equivalent of 80,000 more full-time hours worked, full-time equivalent people, 80,000. The first effect, the people who decide they'll do some work now rather than not work, is smaller than that. In terms of full-time equivalents, probably about 15,000. So the overall effect, you have the two bits together, you're looking at around about 100,000 more people who work. They're going to pay some tax. That will offset part of the cost of the measure itself. That's the 10 billion or so direct cost, but you get some of that back because more people work. And those people produce GDP, and so you get an increase in the supply potential of the economy. And nearly most of that comes from this Class 1 going from 12 to 10.
And when you say that, to what extent have you taken into account the age of the people who might now be incentivised to work? Because it's clear that it is the older members of society, including pensioners who don't pay national insurance, that are the group one is encouraging to come back into work. But clearly, if you're a pensioner, you don't pay national insurance, so the incentive is less.
No, you're absolutely right. So there's been no change there for those people from the national insurance measure. So the numbers I said about people who decide that they will go into the world of work are younger people. Quite often they're people who are perhaps not going to go into full-time work. And that's why the full-time equivalent number of extra people is less than the actual number of heads, because on average we think that these people will not on average be full-time workers.
Do you know how many pensioners are now working, and is that number growing? Because clearly, if there is a trend there, that has some implications for this sort of tax strategy.
I'm not sure this is a very direct answer, but I think one of the things we've learned is that the participation rate for the whole economy, which fell quite a lot in the aftermath of COVID, and people talked about some people talked about the lost million. We don't think it was ever that high, but it could have been 600,000. A very substantial proportion of those people seem to have come back into the labour force. And what in the early days after COVID when people were talking about this 600,000 or more missing people, a story that got quite a lot of attention at the time was that people are taking early retirement. And it seems to me from the latest numbers that effect has significantly gone away, which would suggest that some people decided, I'm not going to go straight back into work, possibly still worried about COVID, but have now actually gone back into the labour force.
Okay, that's very helpful. Can we then look at classes 2 and 4, the self-employed, were specifically targeted for help by the Chancellor, and frankly, well done the Chancellor, because they're usually the ignored group. And what do you think the impact is on those changes? It's certainly getting rid of one class and reducing the other at least streamlines it. But what do you think in the real world, what impact is this going to have on the self-employed?
I think in terms of the general nature of the effect, it is kind of similar to the class 1 thing, because it's just a reduction in the marginal rate of tax, and it's also potentially a side benefit as well is a reduction in complexity. But Tom, I don't know, you've been thinking more about this than me.
Yeah, I mean, I think that is right. Essentially the same kind of effects that David has outlined apply to the reduction in class 2 and class 4 that's paid by the self-employed. But the effects are probably smaller just because the kind of population that is affected is smaller, and also the gain is just a bit less because it's a 1% versus a 2% cut, and the removal of the class 2 flat rate is actually quite small in monetary terms. But I mean, it is also a simplification, because it's certainly the case that the sort of class 2 and class 4 quite a complicated system, so that may also have some benefits. We do also assume in the costing that there's another kind of behavioural effect, which is that it reduces the incentive for people to incorporate to gain a tax advantage. So there's a bit less incentive to do that, which also affects the sort of yield from the measure a bit.
Is that a good thing or a bad thing?
Well, I think again it's a good thing in the sense that you don't really want to you want to try and avoid a tax system that is creating incentives for people to incorporate just for tax purposes. Yeah. So if it's reducing the incentive to do that then that is a good thing, I think.
That's fair. One final question, if I may, Chair. Clearly, there are people who are self-employed because they prefer, or the nature of what they do is very much a one-person occupation. There are others who are innovators, and for them, might this change be something which drives risk-taking and taking an opportunity in a way that without it, those types of individuals wouldn't have taken that risk?
Well, I think that I'm not sure that this change in itself would really be sort of significant enough to affect those sorts of choices, again, for the self-employed, where the sort of monetary value of this reduction is less than for the employed. And we certainly haven't sort of modelled that kind of impact.
Okay, so no particular thoughts on its role in, if you like, kickstarting innovation as opposed to regularising and sensibly making life of the self-employed, frankly, more straightforward. Okay, Chair.
Yeah, thank you very much. Keir.
Wonderful, thank you. I just wanted to talk a little bit about full expensing, if that's okay. Tim Sarson at KPMG has described the policy of full investment expensing as sort of a timing difference which accelerated tax relief rather than kind of permanently benefiting affected businesses. I was just wondering whether you agree with this statement, and if so, kind of what impact you believe this sort of front-loading of investment has on business investment over the longer term?
Well, it is a timing effect in essence, but that doesn't mean it's neutral, because getting the money up front in terms of paying lower corporation tax, because you can offset the whole amount now, as opposed to you can offset a bit now and a bit next year, rolling ahead for 9-10 years down the road, is valuable. I mean, in fact, it's more valuable in a world in which interest rates and inflation are higher. And really, I mean, that's the source of the benefit to investing. And that's really, when we do our calculations, how much is this worth and how much is it going to change investment, it's exactly that calculation. But it also explains why the cost in the short term is so much greater in terms of lost corporation tax revenue than the long term. Because you give people the tax relief up front, that's expensive, but you find that you get more corporation tax further down the road because they're not still offsetting the investment they do today 5-10 years down the road. So that's why the short-term cost looks very high. It looks as costly as the national insurance measure. Actually, the long-term cost is a small fraction of that. So short-term, it's of the order of 10-11 billion. Long-term, probably a bit under 3 billion. So you get most of it back.
And there's not any concern about having a sort of peak in business investment as a result of the measure being put in place, which then, to an extent, tails off afterward. That's not a concern in relation to forecasts.
Well, it shouldn't be, no, because it's a permanent measure, and therefore it has a permanent effect on companies wanting to invest a bit more. So it's not like the temporary measure where in 2 years' time the thing goes away. So pull your investment forward and then you get a drop off in investment. So no, that's one of the benefits of it being a permanent measure. You don't kind of distort the timing so much.
Sure. I was wondering if there was a sort of pent-up ambition to invest, which companies will realise once the measure is implemented, which then has a kind of concurrent tail off over time.
It could be. I mean, there's a slight negative effect actually, because what you've got rid of is what otherwise would have been a temporary full expensing. So to the extent that there already has been a little bit of bringing forward, you kind of lose that because there's no incentive now to bring the stuff forward, since you'll get full expensing 3, 4, 5 years from now.
Right.
So in fact, if anything, in the very short term, you might find investment is slightly weaker because you don't get the bringing forward. But the sustainable and permanent effect is higher investment.
Sure. And, full expensing is the third policy announcement since 2021 that allows for 100% capital deductions if you include the super deduction. Yeah. And I wonder what your assessment is of why full expensing has been chosen as the right kind of policy measure for the moment, as opposed to the other iterations that we've seen over that time.
Yeah. I mean, the first thing full expensing does, for those bits of investment that get full expensing, and where investment is financed from retained earnings or from issuing equity, it makes the tax system neutral. And that's a good thing. And unlike, as we just said, unlike these temporary measures where, well, those companies that feel they can bring forward investment do it, those that can't lose out in a sense, this is permanent, so you don't get those kind of timing, you might almost call them distortions to investment. In fact, those bits of investment that are financed not by companies retaining earnings or issuing equity, but are actually financed through issuing debt, with 100% first-year allowances or full expensing, they become slightly subsidised by the tax system. So if you felt that, part of the problem in the UK was that we had a tax system that distorted away from investment, you've certainly got rid of that when you've got 100% first-year allowances. If it's equity financed, retained profit or issuing new shares, and actually you've got something of a subsidy if it's debt financed. And if you thought for whatever reason that the UK was stuck in a low investment trap, you could argue it's not such a bad thing to have a system that is at worst neutral and actually has got a bit of a subsidy element as well. And that's what full expensing gives you. Of course, it doesn't apply to all investment at the moment. So if you rolled it out to everything, you really would have a tax system that was neutral to subsidising investment as opposed to disincentivising investment.
Sure. And, the IFS has said that one of the trade-offs of this policy is that it creates a bias towards businesses investing in qualifying plant machinery rather than focusing that business investment in other places. Yeah. Is this factor identified in your forecasts, and do you have any concerns over that sort of narrowing of business investment toward qualifying machinery rather than it being used for other purposes?
Well, I think it depends a bit on whether they're substitutable. So, if a company could do some investment that fell outside full expensing, and that was a very close substitute for plant and machinery, then you could see that it would cross that boundary. Bit difficult to quantify that, and in some sense, if you have a piece of investment that's in research and development or something, which may not get full expensing, versus buying a van, they're not really substitutes. So it'd be surprising if a company said, we're going to do less research and development and buy a load more vans, because they get the allowance. So I suspect there's not a whole lot in that.
Thank you. Thank you, Kate.
Thank you, Chair. Let's talk about tax avoidance for a minute. In the autumn statement, it included what is said would be tougher consequences for promoters of tax avoidance schemes. Your forecast for this is £1.3 billion per year. How did you arrive at that figure?
So there were, I guess, a number of anti-avoidance measures that the government announced this time. The main one is actually a sort of international measure, which is designed essentially to ensure that multinationals pay a kind of minimum level of tax across all of the countries in which they operate. And this is a sort of OECD-led initiative. We actually scored the sort of first part of that at the autumn statement, which was the largest part of it, which we estimated raised around, I think it was 2 billion. And this is the kind of final stage, or the next phase of this, which raises a further amount. I mean, it's definitely the case that, and we explain this in the book, that there is a lot of uncertainty around the revenue that will be raised through this measure, by the nature of the fact that it's international, based on an international agreement. It requires having a understanding of kind of corporate profits across different jurisdictions, and being able to kind of operationalise this system across different countries. But nevertheless,
are you saying it's not really possible to forecast the behaviour of potential tax avoiders?
Well, it is possible, and we work very closely with HMRC in order to do that. But I mean, it is definitely the case there's a lot of uncertainty around it. And in this measure in particular, there's a very high level of uncertainty, which again we flagged up.
The bigger problem is tax avoidance for the UK in general.
Well, I think like every country, the UK has a tax gap between taxes which sort of theoretically could be raised and what is actually raised. I don't think we've got a number for that overall in the book, but it is obviously significant.
Given that significant challenge, what are the challenges for you then? Going on what you've just said, it looks like really, really difficult to pin this down and nail down a jelly. What are the challenges for you in terms of forecasting the behaviours in the face of particularly new sanctions?
Yeah, I think as I say, this measure is a particularly uncertain one because of the international dimension. There are also some measures that are kind of focused on UK tax system alone. Even on those, we always assume that there will be a significant kind of behavioural response in so that people will change their behaviour in response to the new measures that the government is introducing, and that therefore, I think almost in all cases, the yields will tend to fall over time because people react. And I guess that's why, essentially the government has to kind of keep going with new measures.
Let me go back to the original question, which remains hanging and unanswered at the moment. How did you come to the estimate of £1.3 billion per year then?
Well, the sort of stages of doing that are set out. So we've worked very closely with the HMRC and our analysts on this one, who've also been working with the OECD in order to produce these estimates. And essentially you start with your best estimate of the kind of revenue that these multinational companies generate. You do assessments of where that where their profits are generated in individual companies.
In case we run out of time a wee bit, if you could just come to the point where you arrived at the figure of £1.3 billion, that would be really helpful.
Well, I mean, it's a bit difficult to say because there are multiple stages that are involved in getting that estimate.
Yeah. Okay.
Essentially, you're looking at their taxable profits internationally.
Right.
You're then trying to identify where they are maybe generating those profits in jurisdictions where they're not taxed at below this 15% minimum level, and then trying to estimate, therefore, how much additional tax will be raised through the measure. But I mean, it is a complicated set of steps that are involved.
Well, let's come on to those OECD Pillar 2 measures that you were talking about in terms of tackling multinational companies shifting profits offshore. The autumn statement says £12.7 billion will be raised over 6 years. Your costings only show one of the three elements totalling £1.7 billion. Why is that?
I say, so part of this was scored previously at previous events. So it's a reform that is taking quite some time to be introduced given the complexity, and it's been announced in different stages. So different parts of it have been scored at
You can
different
break
events.
down that £12.7 billion figure from the Chancellor.
We will be able to, yes.
You haven't as of yet.
We can, because it's been split across several forecasts and announced in various components. We haven't put it all together. We can certainly make an attempt to do so in writing if that would help.
Well, since you haven't put it all together, you gave this costing a high level of uncertainty. Do you stand by that? Yep.
Yeah, I mean, for all the reasons I've set out.
Why did you give it that high level of uncertainty?
Well, I mean, essentially for the reasons that I've been talking about, because it is based on international agreement, so you have this sort of additional complexity that this has to work across a number of different countries. You have uncertainty around the data that are provided by the multinationals on their profits and taxable profits. You have uncertainty about how this would be operationalized across different countries, and you have uncertainty about the behavioral response of the multinationals. So I think there are a number of different layers, if you like, of uncertainty, which is why we've given it that high, very high uncertainty rating.
But those challenges will be faced by the EU, Canada, Australia, others that are adopting this as well for it. Okay, let me go on to talking about managing and settling tax debts. The HMRC has been allocated £163 million to manage that, and is that efficient? Is that sufficient? Or should I say £163 million?
So I think on that measure, we have actually a pretty good evidence base from similar measures that have been introduced in the past, that when HMRC does put more resource into this area, which is tax debt collection, that they have been effective in generating additional yield. And that's why we...
Yield is forecast to be £5 billion, yes? That's what the forecast is.
Over the whole forecast
period. That's
I've got that figure right. I haven't got that figure right in front of me, but if
I understand that is
if
your
it's in
figure.
the book, then yeah. But as I say, so this is a measure which is targeted at tax debt collection, and it is the case that tax debt rose quite significantly through COVID and after COVID. So there is an increased amount of debt which HMRC can collect. And as I say, we've got pretty good evidence that in the past, when they've put resource into that they're effective in collecting that debt.
Okay, and was that based on HMRC evidence then, the work that you did to produce the £5 billion figure?
Well, so we work with HMRC to produce those estimates, and we scrutinise them very carefully. And as I say, on that one, on the basis of evidence that they've been able to provide on previous similar measures is why we've scored that amount.
Okay, and does the 5 billion, which obviously you're going to check, raise, take into account the behavioural effects of encouraging taxpayers to settle their tax debts?
So again, it will. I have not, I'm afraid, got the full details of the behavioural effects that we will have included in that measure right in front of me, but there will be some account taken of the fact that there will be a behavioural response, yeah.
Professor Miles or Richard, do you want to add anything?
I guess just as a general point, I don't think in areas of tax compliance is an area where we get particularly taken for a ride by HMRC or by the Treasury. And the government has had some quite conspicuous successes in closing tax gaps in key areas. I think the most conspicuous areas in the area of VAT, where the VAT gap used to be something on the order of, so the gap between the sort of notional liability for VAT and what is actually collected, used to be around 3% of GDP, has fallen over the course of a decade or more down to around 1% of GDP, and so that is success in collecting a whole lot of VAT which wasn't previously being paid. Now, part of that is probably due to more digitalization of businesses, the sort of cash disappearing from society as a means of settling transactions, and so supported probably by some wider social trends, but also a sort of determined effort to close these tax gaps. Similarly, the government has taken a lot of steps to close loopholes in the corporate tax system and basically broaden the base for corporation tax, and you've seen that show up in higher receipts from another big source of revenue. So we look pretty hard and with a pretty jaundiced eye at proposals for sort of spend to save compliance measures from HMRC, and do make sure that they take account of behavioural effects and other things which might reduce the net yields. But HMRC has a track record of doing reasonably well and actually tracking down these missing receipts.
Okay. Thank you, Chair.
Drew. John.
Thank you. Good morning to you. What I wouldn't mind doing is just turning to the OBR's assessment of the economic impact of the announced increases in the national living wage. A quick question, if I may, to start. Why did this change not feature anywhere in the OBR's economic and fiscal outlook document?
So we had to sort of anticipate where it might end up in putting together our overall wage forecast, but because it is announced essentially after we close the window for measures, it's not something which we take explicit account of. But it was something which is consistent with our forecast for nominal wages.
Is that something are you going to come back to it now you know the figure?
We'll provide more information about what it would imply for sort of future levels of national minimum wage were you to try and maintain that level going forward. So it's an area where we will probably look to provide some supplementary information. But because that information arrived after we closed our forecast, we had to basically make an educated guess as to where it might end up.
Okay, fair enough. The figure was nearly 10%, as you know, broadly speaking across the board, as a minimum, ahead of inflation. I mean, what is your assessment of the impact on inflation now that you know the figure?
So we think it would be pretty marginal in the sense that what you wouldn't expect is for that to just be reflected by shifting up the entire wage scale for the rest of a given firm, because that would clearly be unaffordable for most of them. So by implication, we're assuming some compression of the wage scale between the lowest paid and the highest paid in order to accommodate that. We don't think that it would make a material difference to the inflation outlook in and of itself.
Right. As you know, universal credit tapers away as income rises. I mean, have you done any work now that you know the figure on how much the government will save from this measure, given that national living wage tends to be a cost borne by industry?
It's not something we've run through our labour models, unfortunately, because the announcement came in so late. Because it's not something because it's not a fiscal policy measure that we explicitly score and whose economic effects we take into account. You can think of it as being sort of implicit in what we assume for economy-wide increase in wages and earnings.
Okay, all right.
If I may I just add something very briefly? The main reason that we increased the overall forecast for average earnings relative to March was that inflation had turned out quite a bit stronger, and tightness in the labour market was also a bit stronger than we thought it would be by now. And I mean, to the extent that those are factors which underlay the decision on the living wage and minimum wages, the underlying driver of that is in effect in the forecast, because we've got wage settlements, I think, 2% higher this year and 2% higher next year than we thought in March.
Right. Okay,
so you've got a bit of it in there. Yeah, indirectly, I think it has had an impact. Yeah.
Can I just explore with you about the logic of it and whether there's also other objectives with the increase? I mean, we know that the objective is to aim at 2/3 of medium wages, and we're heading in that direction with this increase. To what extent do you think that it is a deliberate policy to make work pay? And coming back to your earlier exchange, I think with Anne-Marie about the missing 600,000 immediately after COVID. I know that's an estimate, and we think that figure has gone down. Yeah. When I say missing, I mean people who have withdrawn from the workplace, just to be clear to those listening in. But it's still, that figure may have come down, but it is still quite high. It could be a couple of 100,000 very easily.
Yeah.
To what extent do you think that the increases in the national living wage will encourage at least a good segment of those people to come back into the workplace?
I mean, you're right. You're absolutely right about the 600,000 lost. We found quite a few of them, if you like, but there's probably 250, 300,000 still have not come back. So it's not gone away for sure. I think the tricky thing is that, I mean, who wouldn't like it? I mean, who would be against wages being higher for people, particularly at the lower end of the wage scale, and that having a positive effect on labour supply? The problem is that what impact is that on companies? And if it's not matched by productivity or changes in work arrangements, then in itself, it's not a free lunch, because companies will decide, well, do we really want to employ people at the margin when it's going to cost, considerably more if there's just by government edict or some decision of some advisory committee that the wages are just higher. So I don't think you can, in a sense, just in some ways legislate your way to prosperity. Of course, if it's a spur to productivity enhancing measures amongst those groups of workers who are going to be paid, significantly more than they otherwise would be because of minimum wages, then it does have positive supply side effects.
Well, can I pick you up on that point?
Yeah, sure.
I mean,
sure.
We've mentioned before in this evidence session about poor productivity.
Yeah.
And, there is a line of argument, economic argument, that, one reason for that is that we've relied too heavily in the past on relatively, if you'll excuse the expression, cheap labour, as a substitute for investment. Now, is there not an argument to be said, therefore, the quid pro quo is being that if you increase the national living wage, you're going to be... And don't forget, companies have a reasonably competitive corporate tax rate when compared internationally. Yes. This may encourage greater investment when it comes to productivity.
I think there is something in that. And if I can sort of stand back a bit, if you think about, we've had minimum wages now in the UK for decades. And when they were first introduced, I think there was a feeling that this would be detrimental to employment, that you might think on distributional grounds it had some advantages, but you were going to pay a price in terms of less employment. And I think that the lesson of the last few decades is that there's been a surprisingly small hit to employment. And I think it's because of the mechanism that you describe has been at work, that you incentivize productivity enhancing investments by companies when you make, quotes, cheap labour a little bit less cheap. I think there is something in that.
Have you done any analysis on that? Because, we often hear, and this is important with regards to the economic argument generally, it's important when it comes to predicting growth rates, perhaps even inflation. Have you done any analysis as to this in more detail, in the sense that, if you and I perhaps are right, Professor Miles, then you know what the government is doing is not just helping people at the low end of the pay scale, but maybe, and I agree with you, you can't legislate for prosperity, but you can nudge companies through the tax system and wage system in the right direction.
We haven't done detailed work on it. I know that one of the experts in this area, Professor Alan Manning at London School of Economics, has done work over a long period of time on the impacts of things like minimum wages. And I think he did some sort of quite pioneering work which suggested that the negative impacts would be offset by these kind of mechanisms. So I think there's certainly something in it. As Richard said, we weren't able to allow for the specific announcement that was made very recently in this forecast because it came before we had finished our analysis. But I think it's something that we should think carefully about, actually. I
would just suggest to you, before I move on briefly, I'd just suggest to you that at a time of record employment or near record employment, certainly a strong labour market, and indeed, when we have reasonably competitive corporation tax rates in this country when compared to near and far neighbours, this might be a good time to look at it, because I think it's certainly an objective to keep driving the national living wage up.
Yeah.
And that's not just the right thing to do to help people at the low end of the pay scale, but it could help large companies when it comes to productivity. Can I just move on very briefly? The increase in the national living wage, has there been any assessment done on the impact it will have on income tax receipts? If not, are you intending to do that? I mean, it might be marginal, but every 10 million helps nowadays.
We could certainly have a look. It would be very low because quite a lot of these people are earning either close to or below the personal allowance. So I would be surprised if it had a significant one.
Okay. And very finally, we know that this is going to be a cost borne by industry, particularly perhaps small and medium-sized enterprises. Have you done any assessment on the extent to which that may impact their profitability and their ability to pay corporation tax and so forth?
I think as I said, we've got a general assumption about what happens to earnings across the economy, and across across sort of various buckets of the income distribution. What we don't do is run a specific decision about the national living wage through that to see what it does to tax receipts. But it stands to reason. It stands to reason that if wages turn out to be higher, that squeezes profit margins, and you've got less than